there are 22 Western states that Thomas Jefferson at one point, I'm pretty sure he thought that, we'd be an agrarian society. And so he drew a grid on every territory before it became a state and required that a decent portion of the state would be held in trust for public schools. And, instead of blocking off or being strategic about any oil and gas, et cetera, it's just every so often you're going to have a public square or a school campus of some sort. And so just all over these 22 Western states, there's just this checkerboard of land that's held in trust for public education.
Welcome to The Derivative by RCM Alternatives. Send it.
Hello, my name is Peter Madsen. I'm the Chief Investment Officer for the State of Utah's Sovereign Wealth Fund, called the School and Institutional Trust Funds Office, or better known as SITFO. We like to say the money's old, going back to Thomas Jefferson and the inception of the state of Utah, but SITFO is relatively new. And I enjoyed the discussion talking about, of course, skiing, as well as asset allocation and our use of managed future strategies. Hope you enjoy. Coming up on The Derivative.
All right, everyone, we're here with Peter Madsen. I'm guessing coming to us from snowy Utah. Where exactly are you in Utah?
I'm downtown Salt Lake City, Utah. I live a couple miles from downtown. I'm in the office today. We're right on Main Street.
Nice. So where, as listeners know, I always spend way too much time talking skiing. So what's your favorite ski hill? Where do you go?
Yeah, we could do a skiing podcast.
Nice.
Might be more enjoyable, but being based in Salt Lake, it's more of a strategy about given day and given conditions and where you think crowds are, especially with the way the new passes work. So, for example, this weekend the plans were we expect a little bit of snow. Should we go to the resort? Which one will it be enough snow for it to be a POW day, or should we do some backcountry where we expect there to be fewer crowds and get a little more exercise? So that's kind of the nature of it versus it. But I did spend 4 winters right after high school working at Brighton Ski Resort. So
Oh, nice.
there's a fondness for Brighton. Love going there and can really just kind of feel like I can let loose because I know the mountain so well.
I love it. I was a similar, except after college, ski bum in Aspen for 2 years,
Oh, nice.
slopping chili up on the mountain. So I
Yeah.
know it. And then I'm out there probably twice a year now with some friends' houses in Park City. And so love it out there. Except I'm always torn. I'm at Park City. My buddy's got a house on Deer Valley, beautiful ski in, ski out. What's not to love? Except I'm like, oh, can we go over to Alta and Snowbird,
Yeah.
please? Like,
Yeah.
there's not quite the terrain at Deer Valley that I would hope for, but beggars can't be choosers, right?
Yeah. It's Deer Valley is the go-to for icon pass holders when Alta and Snowbird are snowed in or the canyon's closed.
Yeah. And then tell me quickly about your backcountry. So you skinning up and skiing down? What are you doing out there?
Yeah, skinning up, occasionally do something a little more adventurous that might require, having some crampons or putting your skis on your pack and post holing up, something a little steeper.
Ooh,
But a lot of it's, in the interest of just being safe and having a good time. A lot of it's pretty mellow. There's a lot of low angle, not really massive peaks here in the Wasatch, our like Snowbird and Alta, and some of those resorts have great steep terrain, but off on some other canyons, it's pretty mellow. Some of them you can take your dog. So it's really more about just getting outside, getting some exercise, being with friends and, making some turns, but it's not aggressive or challenging skiing typically.
yeah. And it's always interesting to me. We've had Veneer Bensali, who runs a volatility fund, super concerned with risk and hedging and volatility. And he goes out on these helicopter skiing, snowboard. He does this desert run, all this stuff. So his personal life, he takes a bit more risk than in his professional life. So
Yeah.
it's always funny. But it sounds like you're saying, oh, no, I'm aware of the risks in the backcountry as well.
Yeah, we're pretty safe. There's a couple of us old timers that, have been around a long time and, taken safety courses and training, avalanche rescue training, et cetera. So we don't tend to just it's a pretty select few that I'll go out with, experienced people who I trust and who have really strong knowledge about either the weather or snow conditions or, avalanche safety, those kinds of things.
Oh, well, that just blew my next question of whether, when I get out there, whether you can take me on one of these backcountry trips. So we'll
You could
see.
do an easy one maybe.
All right. I've passed some of that stuff. I've always wanted to do what's the mountain when you're sitting in the Snowbird Alta parking lot, looking kind of back down valley right there, that big one.
Superior.
Yeah, and people you can see them going up.
Yeah. Yeah,
You
that's
done that
Mount
one?
Superior. That's a great one. Typically pretty high risk to ski that one. You need the right conditions, but that whole ridgeline right there is a go-to backcountry spot that yeah, it's don't get me started on parking and infrastructure and crowds and
Well,
anymore
what?
it's just so busy. Like there's just a stream of people doing backcountry, especially right up in that area.
Uh, well, I did want to ask you, you Utah born and raised? Are you a transplant or?
Um, More or less, I grew up in North Carolina, went to junior high, high school, University of Utah, moved away for almost 20 years, and then I've been back now about 9 years. So my wife teases me because I don't like to say I'm from Utah. I like to give the full longer history, but at some point I'm just going to have to say I'm from
Say you're
Utah.
from Utah, right? But what do you make of the growth? Like Park City just seems to be going crazy, right? They're going all the way out to the reservoir now, $6 million houses. Like, is that sustainable? Are Utahns, what do you call yourself? Utahns?
Utahns, yeah.
Are they happy about that? Or is it
No,
pricing
no
people
one's
out?
happy about that.
All right.
And you gotta kind of make peace with it. But growing up, being able to go skiing at lunchtime, when I learned to ski, you got on the bus out in the valley and during lunch and had a sack lunch and skied, took lessons in the afternoon, went home by dinner. And anymore, it's like on a weekend powder day, it might take you 2 or 3 hours to get up to Alta or Snowbird.
Yeah, it's crazy. Um, so what do you do about that? Like, and then there's this new private mountain that's up near Snow Basin with who knows what that costs, 5 million plus to get in.
Yeah, it's a 500,000 membership fee, and then I'm not sure if, like the Yellowstone Club, you're required to buy a property. It wouldn't surprise me. I'm just not sure about that, but because that's, ultimately how they make the money. I'm not sure that they just want to sell, you know, lifetime memberships. But that resort is, yeah, that's something else. That was really surprising, somewhat controversial. Just, the locals around there had access to that area
Mm.
and now they no longer will, and it's a pretty big swath of, I mean, it's
Who
it's a proper resort.
who sold it? It was privately owned.
Yeah, it's kind of, yeah, it's just interesting. It was a ranch. I guess they called it a ranch.
Mm.
They marketed it, but and maybe that's still in the name. I think it might be called Wasatch Peaks Ranch. The owners of Snow Basin, which is a great resort in Ogden,
Yeah,
which
I
used
love
to
it.
be less traveled, but the 2002 Olympics, I think it was the downhill was competition was held there. That family, I think it's a family, the people who own Snow Basin owned that property and sold it. And
Uh,
not sure why they didn't develop it themselves, but sold it. And the buyer, the condition was they couldn't create a competing resort. So the private resort was, I don't know if that was the original intent. I'm sure it probably was, but
yeah.
that's the stipulation for selling it.
I have the specs right here. 1 million to join, must buy land for 8 million plus, must build a 5,000 square foot house minimum, and break ground inside 5 years.
Wow.
So
I'm just
yeah,
shy. I'm just shy.
there's a lot going on there.
Yeah.
Um, all right, for all those who didn't come here to hear us talk skiing, but what's your overall? We'll close up Utah. You're bullish. Everything's going great. I mean, you must be. You work for the state, but um, you think it'll cause problems long term, or you guys will figure it out?
Yeah, hard to
All
say. I think we'll figure it out. I think, one aspect of, Utah originally was built around this kind of I don't know if you call it infrastructure, but the streets are really wide downtown. I'm sure
Yeah.
you remember being down here, and a lot of our downtown streets are, if there isn't a train or bike lane now, they're 4 lanes. So two each way plus a turning lane. So there's, plenty of room to, while it's trafficy, et cetera. But if you're just in and around Salt Lake and the Valley, it's not terrible. Public transportation's okay. The and then the opportunity for, I think the term is urban infill. You're just creating density in Salt Lake City is, the buildings are going up rapidly.
Mm.
We've got our first couple new skyscraper type hotels downtown. There's tons of luxury apartments going up, and so I think it'll be, we'll manage. We'll become ultimately like Denver or Seattle. Hopefully not as trafficy as LA, but getting from one end of the valley to another is pretty painful. But as long as you can stay pretty close to home and manage to get out early to on a powder day, you'll be all right. Ride the bus on a powder day.
Let's get into the firm and we'll weave back. You said North Carolina, and then back to Utah. So what was your kind of personal background, got into the investment world, and how'd you end up working for Utah?
I kind of fell accidentally into institutional investing. I was studying Russian, spent a little bit of time in Russia. I thought I'd be an academic, really liked the idea of, studying great novels and history and art and sharing that with others. I thought that was something I really wanted to do. And as uh, I met my wife and things started to kind of change and people I was meeting and things I was learning, and pivoted as quickly as I could into like international relations or international political economy type of classes. Ultimately graduated with the Russian degree and then went straight away into an MBA program and graduated right, at a time it was tough to get. It was early '01, and a family friend of my in-laws happened to work at Russell, and
Hmm.
a group that spun out of Russell, their manager research department, an individual named Jeff Hansen, great guy. I'm still friends with him. He was consulting, doing management consulting, if you will, and research for asset managers. So, they're like, maybe they want to rationalize the product line, or they're wondering if they have the right PM and the right talent on the team and personality profiles and all those kinds of things. So I joined him, not really knowing much at all about investing, especially not institutional investing. Just
And
having
this is like
some.
Russell, the index company now, or
Yeah,
before
Russell
that?
was
Yeah.
one of the first pension consultants,
Hmm.
and they were maybe the biggest pension consultant for a long time. And so their manager research group, then they started managing money. Their manager research group was pretty strong, pretty big. Again, like one of the first, folks to even do manager research. And they were managing their own funds at one point. So, a lot of resources, a lot of people, a lot of coverage, a lot of strengths. But a small, one guy spun out and a couple of people joined him on contract. And they all were seasoned professionals, and I was the newbie who just happened to be in the room with, CEOs and CIOs of large asset managers, taking notes and running the data, being the guy with, behind the software and the spreadsheets and all that. And that was great. But it was a boutiquey thing, and it was well, what was the regulatory, um, I want not Sarbanes-Oxley, but Elliot
Dodd-Frank,
Spitzer. Oh, was
or before
Elliot
that?
Spitzer passed something that got rid of the soft dollar,
Oh, yeah, yeah.
really put the dampener on how soft dollars were used. And of course, all of our fees were basically paid by soft
Hmm.
dollars. So that we really struggled, and I ended up the short stint at Parametric, and they were doing a lot less strategies than they do now. It was mostly passive, tax efficient, passive separate accounts. And so that didn't last very long. It's, great people, great shop, invest with them today, but just, as a research kind of oriented person, being on a mostly passive desk, if you will, was, something that wasn't in my destiny. So ultimately joined
Doesn't sound too
RVK.
exciting.
Yeah, it was like running optimizations on how to keep the tracking error low and what to buy and sell, tax efficient kind
Be
of.
good for the ski life. Like, looks
Yeah,
good. We're all lined
yeah,
up going skiing.
yeah, basically. Yeah,
Um,
joined RVK in Portland and did some consulting there for about 5 years, and great people, loved living in Portland. Family was super happy. Things were going really well, but met a group, fund of fund, that it's kind of a hedge fund platform that had some direct strategies as well as a fund of fund, and did some research. Ultimately, joined them, moved to London. Super important for the family. Great time. Could talk about that all day again.
yeah.
And then that wound down as well. Just fund of funds. It was tough to raise capital when I joined. We were about 1 billion when we decided to wind it down. It was about 1 billion, but we had also raised about 700 million during that time. So it was kind of being on a treadmill. And a couple of the consultants, once they saw the flows coming out, they decided they didn't want to be the last one, and so we ended up winding it down, and was fortunate enough to have a long runway to talk to some recruiters. And I was telling them, it's pretty laughable, but I guess I didn't know any better, but I was telling them what I'd really like is to be a CIO in a mountain town, or on the West Coast somewhere. And they were laughing like you and everyone else. And then a few weeks later, one of them that I had talked to got the contract for the CIO position to recruit here for SITFO, the state of Utah. And she's like, "You're not going to believe this, but this would be a great fit for you." And at the time, it's like, the pay's not great, but it's a brand new office, and it sounds like they're going to give whoever joins a lot of runway. And so that was 9 years ago, and we've, a lot's changed, and 12 people now.
The A lot to unpack there. First, part of me goes to everyone thinks soft dollars nefarious, right? So there was nothing nefarious you guys were doing. That was just how the game worked, right? Do you think that kind of they threw out the baby with the bathwater with that whole ruling?
Yeah, I'm not really sure, just because the it is nice to just have an explicit price for something,
Yeah,
have a
yeah.
service or a product and have a price for it. So I'm not really, other than I was super happy doing what I was doing, could have done that forever. It's I wouldn't be, doing the things I've done, and so I'm not really too disappointed in that. And the idea that you're paying for something, and the fees are used elsewhere, it's just not, it's not ideal. So.
And then my brain was the CIA ever recruiting you when you were getting a degree in Russian?
I went to a school where most people were employed by one government or another, because half the student body were foreigners. You needed to speak another language. It was that kind
Ah,
of policy oriented school. They only have a few degrees, and one of them's policy, one's business, one's translation and interpretation. And
what's the school?
it's the Middlebury Institute of International Studies.
Oh yeah.
It's in Monterey, California. There's a few military kind of things going on there, Naval Postgraduate School, and defense. I can't remember the name of it, but the Defense Language Institute or something like that. So yeah, I did get a call from like Acme Incorporated or something at one point, and talked to them a couple of times, and they had me fill out this all this paperwork and asking
International
me about my
exports.
relationships in Russia, and then I had to write an essay. And this is really it's kind of embarrassing, I guess. I don't know, it's funny, but it was a long time ago. But Russia was in a pretty strong period of chaos, and Yeltsin was a bit of a crony, right, to put it lightly.
Yeah.
And Russian history, the philosophy is that they need kind of a strong hand or a strong ruler, and they go from order to chaos and order to chaos, etc. And so when Putin was announced, it was like, oh, well, here's a strong hand, and that will be better than, because when I was living there, it was mid 90s, and there was a lot of suffering, a lot of poverty. It was really dramatic, actually, really tragic. And so, I wrote my essay on why Putin's good for Russia. And
Uh-oh. Yeah.
I didn't hear
Well,
back after that. So,
Someone may argue that that was the case. Maybe not good for the rest of the world, but maybe good for Russia. Let's get into the firm, or do you even call yourselves a firm? What do you call yourselves?
We call ourselves a sovereign wealth fund.
Really? Nice.
Yeah.
Yeah.
A lot of folks would historically would have called this the permanent fund.
Yeah.
There are a few, there are
Like in
22
Alaska?
of us. Yeah. So like Alaska, if you'd like, I could kind of describe this. There's a cohort of us. I could kind of describe
Yeah, definitely.
who we are. And so there are 22 Western states that Thomas Jefferson at one point, I'm pretty sure he thought that, we'd be an agrarian society. And so he drew a grid on every territory before it became a state and required that I think it's either one, it must be 1/16th. I always forget the exact number, but a decent portion of the state would be held in trust for public schools. And, instead of blocking off or being strategic about any oil and gas, et cetera, it's just every so often you're going to have a public square or a school campus of some sort. And so just all over these 22 Western states, there's just this checkerboard of land that's held in trust for public education. And, different from Alaska, who set their sovereign wealth fund up just as, benefit
Royalties. Yeah.
from the royalties of oil and gas. They also have,
Uh,
22, this public education type of trust, slightly different. But some of us, have oil and gas. Some of us have a ton of oil and gas. Some just have land that they sold off and just, distributed the money right away. But a few of us are pretty active endowment like strategies, if you will, teams that kind of look somewhat like a pension fund, somewhat like an endowment, portfolios that are kind of between. And some of us have more public scrutiny than others, but one of the New Mexico's growing rapidly, really strong performance, lots of oil and gas money, really important to the state. I think they have multiple trusts now and, offsetting taxes and supporting other programs. So we're about 3.7 billion. We distribute about 100. We're all unique in some ways, but those are the kind of basic
and that's
similarities.
22. I'm trying to think how many states are west of the Mississippi, but
Basically, yeah.
basically those. Yeah.
Yeah, Oklahoma, Texas, and, kind of west and north. And we distribute about 100 million to K through 12 schools every year. And those checks go to what's called a community council, which is majority parents of the school. And then there's someone, representing the school on that council, but that, kind of advising the parents or, recommending how that money be spent to the parents. And, there's an auditing function to make sure it's being spent on, education or academics. But yeah, it's really great leverage because it isn't part of the overall education budget. It goes
Yeah.
directly to the school who has a certain need in a certain year.
And so what year was this where he put these all, who'd you say it was?
Thomas
Roosevelt?
Jefferson.
Thomas Jefferson. All right. So
Yeah.
way back, way back.
Yeah.
So way before they were even states.
Yeah. So it's called the Enabling Act. And when a territory becomes a state, there's, that's basically the Enabling Act, and it's part of that. So it's kind of like the Constitution of the US, the Enabling Act, and then the state constitution for Utah. And it's super senior in terms of, where
Yeah.
it sits and what
Huh.
claims it has.
But
So
then some,
anytime there's a national park or something there are not many national parks these days, but these national monuments that get created, the feds have to make us whole, so to speak. So there's a whole separate office, separate group that does land management and optimizes and generates revenues, et cetera, from these royalties or disposal of land. But anytime that's usually a really great windfall for us. So, in terms of the assets under management, we like to see those, feds do these big projects, and then we get to cherry pick what BLM land we might want and, group it together and make sure it's near oil or near a developing city.
what's BLM land?
Bureau of Land Management.
Got it. Got it. Which is federally owned.
Yeah, it's like most of the West is
Yeah.
BLM land.
Wait, so that's separate from your trust lands.
That's right. Trust lands.
Okay. Um, and so some of these states just went ahead and sold the land to raise money. And is that how
Yeah,
you get money, or it
it's kind
depends
of
where you're at?
yeah, it's kind of yeah, it's some fared a lot better, and some, like I said, have oil and gas and just good governance early on. But for example, the state of Utah was I think it was 1896, right around there, that we became a state, and this trust was technically established. And let's see, in 1995-ish, so about 100 years later, there was 100 million in the trust,
Hmm.
and most of the, like half the land was disposed of already.
Oh no.
So
Yeah.
100 years, not much growth. And then it got professionalized, legislation oriented around making sure that it had a secure future. And now we're at 3.8 billion.
Who's the gold standard in this in this club
Oh man, we all have our
besides
freckles.
yourselves? Yeah.
Yeah,
Yeah.
we talk to each other quite a bit. There's a dozen or so of us that are pretty active, and have kind of long-term pension or endowment like portfolios, because some are just held in cash, for example.
Yeah.
They haven't bothered to change the statutes or change the Constitution. But for example, we have a lot of the characteristics that an entity like us should have. So we have 4 independent trustees. The state treasurer is always the chair, and he's an elected official. And then there's independent committees that work to nominate the other 4, who there's criteria about them being investment professionals, basically, to become a trustee. And then their responsibilities are outlined really well in the statutes, the
Do they have
legislation.
to live in Utah?
No, you don't have to live in
Oh,
Utah.
all right. Throw my hat in the ring
Yeah,
next
okay.
time.
I'll put your name in the ever-growing list of people who are kind and generous enough to take to take this on and help us out. But we are given discretion, to manage the portfolio, the team, the CIO, and through that the team. We obviously have transparency requirements and reporting, but we don't. Our trustees look at asset class, asset allocation, asset class level performance, total fund performance, long-term horizon. We talk about governance matters, investment philosophy, investment policy, intergenerational equity, to make sure we're not favoring one generation over
Hmm.
another. So it's actually really great.
That's not a thing in the United States. Did they know that? Right? You're supposed to just kick the can down the road and screw the next generation.
Yeah,
You guys didn't get the memo.
yeah, I guess not.
So I want to back up for a second, and I'm going to ask about the trustees, but backing up, so you had that 100 million in 95. How did and you'd sold half the land. So how did it become, besides investment gains, how did you get the 3.5 billion in there? Like, what are the ways you get revenue out of there? Whether
The
in Utah specifically, or some of the others, Alaska's clear, right? It's just a piece of
Yes.
every oil barrel sold.
Yeah, so the larger groups, these larger funds, it really is about the oil and gas money for the most part. It's dominant, but there's also you can like we'll one of the so we can do you can lease it for mining, so the
Mm,
gravel pits or grazing. A lot
ski
of those,
mountain.
if we had owned that ski mountain,
Yeah.
probably yeah, that would be nice. But the big windfall for us was shortly after that professionalization, if you will, of both the land management office. The Clinton administration designated the um, Grand Staircase Escalante National Monument in southern Utah,
Yeah.
and all of those lands were, these plots of land are like a few acres every few miles or so. And so it's really hard to just do something on, 3 acres and get a lot of value out of it, especially if it's in an area where there is no oil and gas, or there is no development, the zoning, whatever. So when they created that massive national monument, all of those lands that you could argue were trapped were traded for land adjacent to a town called St. George, which is growing southern Utah. It's just a couple hours away from Vegas. And so all the new homes and all the development down there is more or
Mm.
less on trust lands. And so that was a big windfall. And so any disposal of land or any use of these lands, those royalty checks or proceeds from the sale come into the trust. And then as long
From the
as,
U.S. government.
what's that?
From the U.S. government?
No, it's like, like if you want to,
Or this
drill
Black
oil in
Desert
Utah and you
course
want to
I
do it in
played.
trust lands, they'll
Okay.
strike a deal with you and you'll pay a certain, leasing fee, royalties, etc.
So that Black Desert golf course in outside St. George, I played in an outing there
Oh yeah.
in October. Yeah, flew into Vegas, drove over. So that is crazy, right? It's like you're on the moon. There's lava rock
Yeah.
and everything. It doesn't look like anything else in Utah, but you're that area was traded for this in this scheme.
More or less, yeah.
Yeah, cool. And then I've also driven from Moab to Zion, and
Okay.
you go down that grand staircase. But that was
Yeah.
weird. You're like, what? I don't get it. You see the signs, and you're just driving, and then all of a sudden you're on a like 6 foot wide road with everything's
Yeah.
falling off beside you. You're like, okay, I get it now.
Yeah. Yeah, it's
That's
great.
cool. Um, but so, and sorry, I'm being dense here, but like for you guys to succeed, you have to constantly be selling off pieces of it or not, ignoring the investment piece, which we'll get to for a second. But in order to get any new money, you have to be selling off pieces of the land, or you could
Or
trade it.
leasing it, yeah, selling it. The mineral rights are always retained. So to the extent you wanted to do some fracking under some land you already sold, and you could arguably do that still.
Hmm.
There's some, you know, there's some land out that like it could be repurposed for solar. I think there were some coal mines at one point that are maybe winding down, and there's some discussion on, a solar farm going in that area. So just
Yeah.
they're constantly innovating and optimizing and generating strong, it's been a strong few years of cash flows, which you would think, would just be declining, um,
Yeah. That's cool.
but it's been great. And at some point, if you think about it, it's really just one trust. Some of it happens to be physical, and then we have the financial trust. But even if that did stop, cash flowing, it's, if you value the two at once, it's sort of, it's basically just like one big trust at the
Yeah.
hopefully inflation plus 5% kind of.
And then are you required to pay out that 100 million, or you're paying
Yeah.
out basically what you can?
We have a distribution policy that is really thoughtful, I think, and actually we've changed the state constitution twice now,
Wow.
amended it to increase that distribution, which is one of the more important restrictions that was lifted that some of these other sovereign wealth funds haven't worked on yet, or haven't, don't think it's, worth the lift maybe. But a lot of them were only meant to be invested or defined to be invested in bonds and distributing the coupon. And that's kind of how the original language reads.
You mentioned the trustees, so that's kind of a smaller trustee group versus most institutional. Would you agree? Versus most endowments, or who knows?
Um, yeah, I think that's fair to say. I think there's some research that says any group larger than seven starts to make worse decisions than smaller groups.
And that was going to be my follow-up. Like, how, not to get yourself in trouble, but how are they to work with, right? There's horror stories about trustees punting, right? CalPERS punting on long ball right before the
Yeah.
spike happened and all that stuff. So trustees kind of get a bad rap for not understanding the investment side as well as they need to and making kind of retail investor type mistakes over the years.
Yeah, we're super fortunate in that so when SITFO was established, so the money's, I like to say the money's really old, but SITFO's pretty new. And when SITFO was established, it was basically a task force or study group, because it got to about $2 billion, and the beneficiaries were like, hey, how's this being managed? And we
Hmm.
talked to these other groups, and they have, a team and this and that and consultants, and it was held passively or managed. It was held mostly at Vanguard. Absolutely fine. Way to go. If you don't, have a big budget for managing a portfolio, it probably should be, just a straight do no harm approach. Things were going pretty well. a lot of money coming in from land management, strong growth from a 70-30 portfolio, get to 2 billion. And someone was like, should we be diversifying and having an investment committee and staff, et cetera? And that task force really kind of took as best they could, a best in class approach. So these things like, the trustees, the 4 trustees need to be investment professionals or investment experts. And there's a committee that chooses, there's a committee that chooses a committee that chooses the trustees,
Hmm.
and they nominate 2, and the treasurer as the chair picks 1. So it's pretty independent. And these guys are great because we've had, they're all volunteers, and they're either former CIOs or current, CIOs or director level folks at family offices. And we meet once a quarter. We have an annual summit, and we talk in between these quarterly meetings, just me and a couple of them, or 1 or 2 of them at a time. And it's great. I mean, they really focus on governance and not trying to micromanage, don't not worried at all about meeting the managers.
It's probably smaller than some of the family offices. The whole portfolio that makes me depressed that it's hundreds of years of Utah's pristine natural resources and it's 1/40th of Elon Musk's net worth. Right, right. I think we have our priorities screwed up as a country. What does SITFO stand for? As I'm bearing the lead 40 minutes into our talk here.
School and Institutional Trust Funds Office.
All right. Do we like that name? I feel like we need a better name.
I feel like SITFO is the way to go.
SITFO. All right. We'll keep it for now. And I meant to ask this before, like, does Utah doesn't have a state lottery, I don't believe, right?
No, no, gambling's
Um,
illegal.
which is probably for different reasons, but right, our other East Coast states are running lotteries to do the same thing. This
Yeah.
seems a much better setup.
Yeah. Well, Idaho has both a sovereign wealth fund and a lottery. So
So they get double. I've never seen anyone all excited like we built this whole new school because of the lottery, but maybe it just feeds the beast and nobody knows about it. So let's get into the investment structure. So did you come in with your whole own philosophy, or as you said, it was all in Vanguard, and how did that work of starting to diversify it and get it into, you're here because you believe in alternatives and do alternatives. So what's the current portfolio look like and what was the journey to get there?
when I was fortunate when I was a consultant at RVK, one of my clients that I worked really closely with was this sovereign wealth fund for the state of Oklahoma. And so I was really familiar with the structure, kind of the constraints, if you will, around that original constitutional language. And I worked with Oklahoma to try and to amend their constitution as well. So I had some pretty good experience and understanding with what it would take to run this office, and having had a lot of clients, at RVK, just being in and out of a lot of different, entities, seeing the investment committees and, the team structure, team size, the talent, all those kinds of things. I felt like I was and then having a little bit of a management consulting experience, felt like I was in a pretty good place to build something from scratch, if you will, here at SITFO, with the idea in my mind that, it will grow over time. It will be sophisticated. We'll have a strong team, well compensated, all the resources we need. That was kind of a gamble, anyone takes starting a new job.
Yeah.
And, it's really paid off. But it started with, I remember the first meeting I had with the trustees. I came up with I did a quick mean variance analysis where we were still under the dividends and interest only framework. And it was late 2015, early 2016, and there was a bit of a correction going on. And so I recommended BDCs, MLPs, EMD, high yield. Yeah, I think that might have covered it. And this little, basic optimization and talking about how we can increase return, get some diversification and also increase the dividend and interest payments. And one of the great trustees who's been with us the longest was like, we need to document our investment beliefs, and we need an investment policy before we do anything else. And I was like, oh man, the timing's really good right now, I think. But anyway, so we took the right approach because we had really strong trustees with experience to set the governance up and make sure we, had consultants early on and worked with them to build out, some important parts of the portfolio. It was a pretty tough slog for the first few years trying to get additional budget and funding for growing the team and being able to attract and retain the right talent. And so call it like the first half was pretty rough. And
That
I'd
was
say kind of the year
MLPs.
was COVID, and was kind of like a really tough spot right then, but things just really picked up from there.
I was going to say 15 MLPs had just gotten hammered, right? And
Yeah.
oil and everything got hammered in 14. So you were not just picking, here's these highest performing things. You were doing real work. Um,
Unfortunately, it was 6 years later until MLPs uh, actually took off. So that was a rough road.
we have a good blog post we'll put in the show notes called but the yield, right?
Yeah.
People are like down 80% on their principal and arguing like, but I get 12% yield.
Yeah.
It's weird to think of this thing's literally supposed to be there for hundreds of years, right?
Yep. Forever.
Right. To then you to say like, oh, it's really good timing. But like in the
Yeah.
scope of the thing, what is good timing?
Yeah.
It doesn't matter. So you started to get these pieces in, and what's the portfolio look like now?
Yeah, well, actually, there's an important point I should raise about a lot of these sovereign wealth funds, where, one of the things that I like about New Mexico that they do better than us from a governance perspective is there's something called the corpus in the Constitution, which defines every contribution to the financial trust or every contribution to the trust as the corpus, and we're not allowed to breach it. So so it's basically like having a cost basis.
Hmm.
And theoretically, everything shuts down if we go below that cost basis in terms of a drawdown. So that's a really important starting point. And
So it can exist through return. It's like a principal protected bond kind of thing. Like once you get to
yeah,
that, yeah.
it is supposed to be that way, but I made the argument pretty long and pretty forcefully, unsuccessfully over the last 9 years that modern portfolio theory suggests that you shouldn't worry about that. You should manage your risk appropriately, but if you have a long enough time horizon, certain types of drawdowns should be tolerable. And but that wasn't the thinking in 1896, and so here we are. And so that's an important part of how we started building the portfolio. And I've always been a fan of other strategies, so to speak, which by that I mean not just equities. And when you think about the potential returns from a fair few other asset classes and the relative volatility, you can get competitive returns from a forward-looking basis from a lot of lower vol strategies. Maybe they have more of a left tail, or maybe not. But so we do a lot of things in what we call income, real assets, and defensive. And then we also have growth, obviously, which is public and private equity. But we're targeting about 40% private markets. And we don't have we have a 15% daily liquidity risk framework that we put on ourselves. That's roughly 3 years of distributions. And then but we have more than that in daily liquid and a lot of semi-liquid stuff. So you think about these tweener type of strategies, a lot of hedge fund structures within what you might call credit or private credit or structured credit,
Yeah.
MD, ILS, things like that. And then in defensive, and real assets is what you'd expect, everything kind of real assets oriented, but no duration. So growth is, equity beta is supposed to be mostly equity oriented returns, not just beta per se. And like private equity obviously has equity beta, but you need to proxy it to show it. Income is, or yeah, so we call it grid. So real assets, REITs, natural resources, MLPs, but we try to avoid duration, so not as much real estate as what you would call real assets. And then in income, we have open-ended private credit funds, hedge funds, and structured credit that do semi-liquid, let's call it, and ILS and distressed emerging market debt. And then defensive, we have 30-year strips and macro and trend.
Right. No long ball in the defensive.
We we slugged it out for a long time, for about 6 years with what we call it systematic convexity, that part of the portfolio. And we spend a lot of time trying to construct it and think about working with the consultants to pick managers. And we ultimately went with a fund of funds. And that approach was having a trend and macro as call it the core,
Yeah.
and then the tail hedging, and then carry to kind of pay for the tail hedging. But the way it worked out was those two things kind of canceled each other out, and we didn't have enough trend and macro, and we didn't have enough vol. So
Yeah.
we rebuilt that portfolio where our manager count is not super high. I can't remember where we are now, but let's say if we're at 9 to 12 is like a range of tolerable headcount for managers in that space. But we're trying to get as high a vol we can. So like one of our managers has 40 vol. We try and
Yeah.
talk, if they don't have a high vol share class, we try and talk them into creating one. And or like these options based strategies where the vol or the VAR can be really high, but you just put a small dollar amount in. So that's kind of how the trend and macro portfolio looks like. And the theory is that those should do well over time on a standalone basis, whereas the carry and the tail hedge combos kind of gets you nowhere, and the tail hedge might not pay off actually.
So grid is growth, real estate, income, defensive,
Real assets.
real assets. Yeah, what did I say? Real estate? No,
Yeah.
not real estate. Um,
Some real estate.
and so talk to me for a sec, the real assets and the duration piece. That was interesting. How do you think of that? Just because you have to hold real estate for a period of time, is what you're saying? Or it
Yeah, well,
reacts?
so for us, factors are pretty important, and so we're looking at each of these. If you think, at a really high level, the growth portfolio has the equity factor, the real assets portfolio has the inflation
Hmm.
or, commodity, natural resource type factor. That's the idea, is that it helps with inflation. But if you're doing like real estate lending, and, like we saw in 2022,
Yeah, you're
both
tied to
real
rates.
estate and anything with duration got hammered, and things that were equity in nature, the equity share class linked to, commodities or resources in some way, typically did well. And that's the thesis we have. And fortunately, it worked out in 2022 quite nicely, because there hasn't been a real period of inflation to test that theory. And then income is supposed to be competing with equity returns. While we don't expect it to necessarily beat equity returns, we expect it to be more competitive, and we expect it to be kind of, call it, higher in the capital stack, even if it's not necessarily lending to a corporation. You can just think of these as contractually obligated cash flows. So a lot of the return that comes from there, not all of it, but a lot of it is from some kind of coupon. And that's and then, yeah, defensive is meant to be the diversifier and contribute negatively on a risk basis.
And then how are you putting these together? They have a set percentage or it's risk weighted? What does the
Yeah,
overall
we
structure look like?
we went through a pretty fun process that took about a year. We wanted to be really thoughtful recently. So every year we do an asset allocation, and we've we've evolved it over the years and working with consultants and doing it ourselves to try and look at not just a mean variance optimization, but make sure we're doing stress testing or scenario analysis, looking at mean downside, and mean CVAR and all these things, and putting them all together. And this is putting them all in a table. And then we worked with this consultant called Hyperion. I hope I'm saying that correctly, based in Chicago, and they have a multi variate optimization tool that you can include like kind of any factor. So we
Hmm.
included the the probability of breaching our corpus, the probability of meeting our CPI plus 5, the probability of a forced rebalancing due to illiquidity, and I think that was it. We might have had just regular drawdown in there just to be different from the corpus breach. And we put those all on one frontier, if you will, and worked with that consultant to have some cool kind of not very deterministic analyses that ultimately got us to the current asset allocation we have. And then we have pretty wide ranges around, we have like a healthy range around growth. And then within growth, you have public and private equity and healthy ranges around that. But if you think about it at the very high level, we sort of have an equity beta expectation that we should be delivering. And if we can do, like, for example, we decreased our defensive allocation because we were able to improve the contribution to volatility from that part of the portfolio. And then we put that into other parts of the
Yeah,
portfolio. So
yeah.
we increased our return with a little bit and improved our risk, and then took advantage of the lack of reported volatility, because that corpus breach is, if that's in call it arcane accounting quirk, then the accounting quirk of private market funds is something we can use to
Our
work.
advantage. Yeah. What are your thoughts on that? That's just everybody's playing that game, so why not? Like it seems weird, for lack of a better term, right? Of like everyone knows they're not really true marks.
Yeah.
Everyone using them knows they're not really true marks. So you just kind of bake that into the pie.
Yeah, there could be a different way. I guess the open-end real estate funds go out and get appraisals every so often on a decent part of the portfolio and kind of cycle through that quarterly. That's maybe something that could be standardized in other private markets. And in fact, for example, these 40 Act funds that invest in private deals have daily marks.
Yeah.
Yeah. So there's a way. Not sure how meaningful it is, but I don't think it really bothers most of us who spend a lot of time with it, because it's such a huge, the private markets are such a huge part of the economy. To not invest there would, I think, be imprudent. As long as you can tolerate the illiquidity and you think you have the resources to work with the right GPs in private markets. I mean, there's definitely risk there, and you make sure tread carefully, et cetera. But to like most of the companies are actually private.
Yeah.
So to
Right.
just say, well, I'm not going to invest in most of the economy because I don't like how they get to mark their portfolios, not quite right. And we spend most of us spend a decent amount of time looking. You go once a year, you go on site somewhere with the manager and talk about the portfolio in detail, and hopefully they're quite transparent about the successes and failures of how things are going in these mostly private equity companies. And then not a lot changes quarter to quarter. So you kind of forced to be patient, forced to stick it out. And then in the other markets, real assets is the same way, but in private lending, there's a nice catalyst. They either amortize, or the coupons being paid back, and liquidity is decent in terms of the life of the funds are shorter, and there's oftentimes money coming out quicker. It's a little more liquid. That's also why we have probably a little more real assets and income, especially on the private market side, than a lot of others, because when you do the analysis, you see that they're lower risk, competitive return, and more liquid,
Hmm.
more
And
cash.
so I was that you pre-ran my. Do you think you have less private equity than other institutional investors?
We just upped our target to 20%, and our total private markets target is 40%. And I think a fair few folks have 40% in private equity.
Yeah. And then have you seen right, I think we at the conference we met at, there was a lot of talk of distributions not getting paid, right? There's a kind of a
Yeah.
hold on money coming out of private equity. You're seeing that personally?
Yeah, we're definitely experiencing that. We're in a really great spot right now in terms of being below our target. So a lot of folks are trying to, um, manage they were overweight private equity,
Hmm.
their relationships that they want to keep. They're trying to make sure and, keep those relationships and
And they're
down
having trouble rebalancing,
others.
essentially.
Yeah. So they're not able to commit or re-up as much. And so there's less competition for these capacity constrained GPs. So we've managed to, get access to some strong names over the last few years because of that. And then we'll probably organize a secondary sale, our first one ever here pretty soon. And, the sophisticated groups, I don't know if they say sophisticated, but a lot of folks who've been in private markets for a long time kind of regularly harvest their private market portfolio, do a secondary sale every, I don't know, 2 or 3 years, maybe every 5 years. And just as, there becomes a lot of that tail end capital, which,
Yeah. So
it's
what
not a
does that look
very
like? There's investors out there that want access to such and such fund that they can't get access to, so you're selling them a piece of your portfolio, essentially.
Yeah, sometimes that's the case. A lot of times it's these secondary funds themselves or these 40
Hmm.
Act funds where, you can get a nice IRR, put some leverage on it. It's a really diversified portfolio, put some leverage on it and, get a 15% IRR, maybe not a very high multiple. And the money comes out pretty quickly. So there's, that works for the 40 Act funds and they're growing quite rapidly. And then secondary funds are, everyone has typically has a small allocation to secondary. So that's a pretty big market and growing as well. So there's some liquidity there. It just doesn't operate in the,
Yeah.
you just need to be really forward thinking about that and be really careful about how much illiquidity you take on.
But us private equity haters, that's probably not quite a fair term, but just right in being in my career managed futures the whole time, that's mark to market, minute by minute, every
Yeah.
day. I was like, went into the wrong business.
Yeah.
But that doesn't worry you at all that they're not paying out? Like it's just part of the cycle, or is there growing angst about amongst institutional that this could be a problem?
Well, we're only, kind of 5 to 7 years into it. So you know, we're our plan was that, at about this time we'd start to see some distributions, and we are seeing some distributions, but we've only had, when you go from zero to we're now at about 10 or so percent private equity, a lot of that's newly
Hmm.
deployed. And so we don't have any expectations yet. So we're not in very much of a crunch
Yeah.
situation. And we actually got, this December, I think we had 50 million in distributions from our managers on a call it a 30% maybe allocation to private markets. So that was just 1 month.
So moving on, kind of what you looking at in the markets, what does keep you up at night? That's not a huge worry. What is a huge worry for you? Or do you
You know,
think you've
we're
got it set up nicely where you don't have to worry very much?
I have two. Yeah, well, firstly, I'd say we're so diversified that my biggest worry is that we don't deliver strong enough returns,
Hmm. That you're just
especially
the
in
T-bill
strong.
rate essentially?
Yeah, we're if like everyone looks at the S&P or the Nasdaq and then they look at our performance. I mean, that's not unique to SITFO. It's every CIO out there is like dealing with even their sophisticated trustees who are like, "Oh yeah, S&P was up 24% this year. How much were you guys up?" And you're like 15 or whatever, and they're like, "Oh," and then you have to explain to them, like the drivers, and they're like, "Oh yeah, 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 I know," but you just kind of get that sense of disappointment, and then when you talk to some lay folks or present to the legislature, they're like, "Why aren't you in all equities?"
Why aren't you in NVIDIA?
Yeah.
Yeah.
And so my biggest worry is upside participation not being robust enough. I think
Hmm.
we have good downside. Like 2022, we were, according to some peer groups we looked at, we were, top. performer just because we were flat. And but this year, like I said, we don't have a ton of public equities. We were overweight. We had some good strategies in the book, good managers. So I think we're calendar year to date, maybe 15%. So, feeling really good about that. But I do worry that we don't have enough upside participation, and that's really what stresses me out, is that and outperforming my benchmark, which does have a lot of equity beta in it.
What is the benchmark?
It's ACWI basically for growth.
Oh, each bucket has its
Yeah,
own benchmark.
S&P real assets and high yield 1 to 3 and 30-year strips and HFRI macro and CTA indices.
Oh, man. And then do you worry that, or does your weighting fix that of like that those defensive, right? How do you let the carry, in theory, managed futures 30-year strips should carry positive over time, but over some 1 to 3 year period, they could carry negative easily, right? So how do you use just a weighting concept to make sure that negative carry doesn't overtake the growth and the income strategies? Right, because when
Yeah,
in the past 2 years when income's also been down, then you have an unexpected negative carry in income.
yeah. It's 30-year strips has not been pleasant
Yeah.
last few years, but especially the nature of the drawdown in 2022. But when you look, over time and you look at the stress periods, ultimately treasuries, there's only a few quarters, and 2022 was one of those time periods where there's a negative return from duration from treasuries when equity markets are down. So there ultimately tends to be a flight to quality. I'm not here to guarantee any, that will continue. We took our
Past 3 weeks would be another example.
Yeah, we took yeah, that's a good point. We started out with 7 in strips and 5 in trend and macro type strategies, and we then flipped that to be 5 in strips and 7 in trend and macro, and now we're 7 in trend and macro and 3% in strips with a tactical duration extension kind of leverage model with a third party group.
Nice. And do you get that feedback from trustees or whomever, your neighbor? Like, dude, what are you doing? Why would you be long bonds right now? Like,
All
you
the time.
idiot.
All the time.
Yeah, right. Like, because this is abnormal.
Yeah,
Um,
the ILS one was really painful for a period too. And that's something that, our trustees were like, we really need to revisit this allocation here. And I was like, fair enough. And we did. And fortunately, they were they were like, we get it. We get why you want to do it. We get where things are right now. And so fortunately, we topped up the last couple of years, and it's been, like high teens, net return the last couple of years from that.
Anything else keeps you up at night? Or that's it.
Our overweight in small and micro right now. Really, really losing sleep over that one.
And
Should have
basically
closed it out as soon as the election results came in, but
the Russell proxy, essentially.
yeah, fortunately we've got some good active managers in that space, so their downside protection is really nice, and then they tend to participate in the upside. And but yeah, it's been a rough 6 weeks.
And how do you view things like that when it's become, right, the growth or the Russell 2000s, usually what I look like, and long bonds have basically become equal, right? Every time rates go up, those get hammered. So when
Yeah,
when correlations shift like that, are you guys on deck and looking at that, or kind of a
yeah.
longer term, let it
We
play
try and we
out?
try and make sure we're taking a longer term view, and we do have cash flows that come in and cash flows that go out. So instead of a formal like annual or quarterly rebalancing, each week we're looking at cash flows and forecasting
Mm.
out cash flows for the next kind of 6 weeks. And it's like, okay, well, in each quarter we have about a well, yeah, 1.25% payout. And so we look like, oh, well, this is a good, this is attractive, or, we tend to look at value. We try and have an understanding of the macroeconomic view through some third party providers. And then we have a valuation and momentum score for each of the sub asset classes. We roll that up into a simple kind of quantitative model, and it scores and ranks, and we look at it and say, yeah, I just don't think it should come
Yeah.
all from this, whatever it is. And, do we really want to sell, small cap right now? We just, added and it went really well, but then we had a drawdown and, should we pull from elsewhere? Should we cut risk? We have those conversations all the time. But fortunately, we have money coming in that we just deploy, to kind of offset those things and kind of move in tranches. Very rare that we make a big, rebalance or big tactical move, and most of the stuff is really just on the margin.
Have you seen over time, do you measure it all? Like, do you get a rebalancing premium?
I don't think that I think there is a rebalancing premium, but it's not much. It's more of it's better to rebalance than to let your risk drift and be unaware of where your equity beta is, for example, as it's growing over time. But so we think of it more along those lines. But it can be hard to rebalance if you have head distressed emerging market debt managers, for example, with either they're capacity constrained, and if you redeem, you can't get back in, or you have to get in the queue to get back in, and things like that. So,
right, or it's
is a
the prudent thing to
premium.
do
It's more
last
of a
year,
risk
but
management tool than anything else, I think.
yeah, right. If you're selling your S&Ps to buy more Russell all year, every month or every quarter, that was a losing proposition.
Yeah.
Here we're going to finish up with our new segment, Mythbusters. So, if you can, what's a market myth, investor myth out there that you want to get to work busting?
One of the, I kind of alluded to this in the philosophy and asset allocation work we've done, but I don't think you need to be max equities in order to get a strong return. I think you can compete with equity-like returns having a diversified portfolio. It's obviously dependent somewhat on the cycles we're in, but there's this guy, Edward McQuarrie, who recently has, I don't know if it's a book or just a research paper. I heard him on a podcast and was really excited because I've always thought, look, there's a few lost decades out there just in the last, not even about 100 years. And, do you really want to have it go 10 years as a trust like us with the expectation of making these payouts and having the corpus and, rocking up with the 0% or worse return?
With the 60% exposure or something you're saying? Yeah.
Yeah. So why would you want a 0% decade return? And a lot of people are like, well, it's about the long run, and you should tolerate that volatility, you should tolerate that uncertainty for the payoff. But I think you can compound at a competitive rate without taking that kind of risk. And in fact, this Edward McQuarrie guy's research shows that I'm not going to get this exactly right, but bonds sometimes outperform equities over the long run, depending on when you start and stop the clock. And that some of that research that was done, that was called Stocks for the Long Run, I think was the name of the book a while back. That research, the bond portion of that research, turns out was quite selective. So the early segment of that research looked the earliest history of that research, the bonds they used were, I think it was just one issue from a boarding school in New England. And so there's like 10 or 20 years of this one bond competing with equities. And then, as they stapled on other bonds or whatever to look at the full history, it turns out bonds about 50% of the time outperformed equities over really long horizons. And I don't remember the very specific details on, but we're talking about like rolling 10 and 20-year periods of bonds outperforming equities.
Wasn't Warren Buffett's bet against the names escaping me now, right? Of hedge funds versus equities.
Yeah.
And actually they both put their money for the bet into like some more advanced bond program that outperformed both.
Oh, I didn't know about that.
Yeah. So yeah, I hear you. So the myth is you got to have at least 60% in equities. And you're saying, I'm not
Yeah,
so sure to get a big
people
return.
say, yeah, to outperform or to get high performance, that for your pension or your endowment or your personal retirement account, you need to have a large and significant portion in equity. And I think,
Or if you're a young person, that's a big one,
yeah,
right? Like, oh, you can afford to have 90% in equities, you're young.
yeah, but as you know, if you do the research and you look at, trend and macro, if you have any skill in manager selection, but even if you don't, well, I guess the survivorship bias, if they haven't solved for that in the HFRI, I don't remember, but you put that time series up against 70-30 portfolio, which is, predominantly equity risk, and it outperforms over most long-term horizons. And recently, it had, leading up to 2022 was really terrible for that strategy, but the
Yeah,
cumulative
then boom.
performances or rolling long-term performance, lots of things compete with or can outperform equity.
My theory is there's a macro managed futures fairy, and they just see everyone get disgusted with it and throw it away, and then they sprinkle some performance dust on it, and it comes right back. But the
Maybe so.
right, because it's without fail. Like '08 crushed it. '09
Yeah.
redeem, redeem, redeem.
Yeah.
Um, awesome. Well, thanks so much, Peter. It's been fun. Um, we'll definitely give you a call next time I'm in Utah.
Cool.
We'll
Thank
grab
you.
a
Appreciate
beer or
it.
coffee or get some turns.
Yeah, that'd be great.
All right. Thanks so much.
Thanks for the chat.
Talk to you
Bye.
soon.
You've been listening to The Derivative. Links from this episode will be in the episode description of this channel. Follow us on Twitter at RCMAlts and visit our website to read our blog or subscribe to our newsletter at rcmalts.com. If you liked our show, introduce a friend and show them how to subscribe. And be sure to leave comments. We'd love to hear from you. This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of RCM Alternatives, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed not to make specific trade recommendations nor reference past or potential profits, and listeners are reminded that managed futures, commodity trading, and other alternative investments are complex and carry a risk of substantial losses. As such, they are not suitable for all investors.